Good morning and welcome again to our quarterly call for Technoglass. Well, we'll be reviewing the fourth quarter results as well as the full year 2023 results. Q4 was very much a quarter in line with expectations after we provided guidance for Q3 in terms of revenues, EBITDA, and EPS. We would like to highlight the achievements for the full year where the company was able to attain record financial metrics pretty much across the board. Record revenues, gross margins, EBITDA, EPS, and very strong cash flow again from an operating cash flow and free cash flow perspective. So it was a record year for the company, growing revenues organically about 16%. EBITDA, we grew about 15%. EPS, we were able to go up 18%. And throughout this whole growth, we were able to maintain an extremely flexible balance sheet, as evidenced by buybacks that we purchased during the year, 23.5 million, and the announced dividend increase that we announced this morning for 22%, going into 11 cents per quarter. So what we're projecting from a cash flow perspective is continued strength, higher free cash flow year over year in 2024 versus 2023 on the back of a very strong year. And finally, a record backlog of 870.1 million, which is up 20% year over year. So good financial metrics across the board. We'll go into more detail on each one of them, starting with backlog. As I mentioned, backlog was up 20% to 870 million. That essentially gave us very strong visibility over 2024 on the commercial side. And now we're building into 2025. This is being done in a challenging market based on the positive demographics of our main markets, right? Mainly the Southeast and areas that are seeing, population inflows and better than average demographics, and the asset types that we feel that are probably more resilient to the high interest rate environment that we're seeing right now. For instance, ultra luxury condos, luxury hotels, and things of that sort, which is making it viable for developers to move forward because they have financial closings in place. So from a backlog perspective, the tendency continues to do well, and not only the backlog, but also the pipeline of projects that we're seeing right now even through today, allow us to have visibility that we should be able to continue growing the backlog for the foreseeable future. If you look at the next graph, the visibility afforded by the backlog takes us out 18 months roughly. 2/3 of the reported backlog typically gets executed over the following 12 months, and the remaining 1/3 of that backlog gets executed over months 12 to 18, I mean. So that gives us visibility over the next 18 months as to what the commercial construction segment should look like. Where we have to kind of evaluate current trends is more on the single-family residential side. Touching on demographics and why we're able to kind of outperform and continue having backlog growth on the heels of a high interest rate environment is population growth. Population growth in our main markets was 1.6% year over year versus 0.5% for the U.S. as a whole. So our markets are experiencing better demographics than the U.S. As a whole. And if you look at the granular data on permits, for instance, while permits have gone down year over year in the U.S. and even regionally, if you look at our main markets, main cities in Florida, for instance, we have actually experienced a little bit of growth year over year. So one has to go down and dig deeper to get more granular data as to see why it is that our backlog continues to go up. From a single-family residential perspective, it was another strong year, grew almost 10% year over year in terms of revenues. But more excitingly, I think that we see a lot of avenues for growth going forward. We've spoken about the showrooms initiatives that we have in place to undertake a geographical expansion. We have two that have been operational for a year in New York and Charleston. We have another one which is about to be fully operational in Houston, with the intention of opening up 2 more this year in California and in Arizona. And additionally, what we mentioned earlier in our previous call was the vinyl initiative, which allows us to essentially double our total addressable market. Vinyl is a very large segment where we have received early encouraging signs that we'll be able to ramp that up over time. Digging deeper into this vinyl initiative, we started delivering the first products in December and are currently doing a lot of sampling and testing, mainly with our legacy dealers that already carry both lines, that carry vinyl and aluminum. And the idea would be, or what we're expecting is for those deliveries to start ramping up after Q3 and subsequently in the second half of the year, as we're able to get those samplings and testing in place. The potential for this, as we discussed before, is to be able to ramp that up to about $300 million in revenues per year. Obviously, that's going to take some time to ramp up, but the early signs are encouraging. Moving on to the bridges on revenues and EBITDA. As I was saying, Q4 was a quarter that was in line with expectations, albeit a quarter that was lower than last year based on tough comparables, and a sequential decrease on single-family residential business, mainly associated with interest rates, which we were expecting. So not a whole lot of surprises there. Again, for a full year perspective, we were able to grow 16%, which was very encouraging in a tough environment, with both segments contributing almost double-digit, mainly the commercial side growing as we expected to grow as well faster in 2024 rather than the single-family residential side, where we have less visibility, but obviously we have these avenues of growth that we just discussed. Fiscal year-end EBITDA, we were able to reach $304 million, an increase of 14% year over year. So again, positive results in that respect. What we're expecting that in 2024 versus 2023 is double-digit revenue growth, as we'll discuss later, but with EBITDA probably at a lower margin based on FX, based on mix of business, and what we foresee for the vinyl ramping up over time. Speaking of FX, which was a theme that was important over the last couple of quarters, quarter over quarter, Q4 over Q4, the peso strengthened about 15%, which had an impact of about 5% to margins year over year. And if we take the full year 2023, the peso went from 43.25 to 4,000 as we project going forward. So there is an impact in FX that we're quantifying for as we move on. The peso has been stable for the last 6 months, so we feel that based on projected or what the economies are projecting for the year, we have hit kind of a stable period, a stabilized period, after a strong revaluation that took place earlier during the year. Moving on to the balance sheet, our balance sheet continues to be probably in the best position it's ever been, with a lot of financial flexibility. Leverage right now stands at a record 0.1 times as of year end. Very strong free cash flow for the year, and as I was mentioning earlier, what we're expecting for 2024 is free cash flow to actually step up based on a step down in capex, which we're budgeting to go from $75 million to roughly $45 million. So what that should allow us to do is to be opportunistic. Obviously, we've been wanting to return cash to shareholders through buybacks and dividends. If you look at our return on invested capital on the next slide, we are much higher than our peers, driving a return on invested capital of about 22% versus 9% for our peers. And also that's allowing us, as I was saying, to return cash to shareholders. We just increased our dividend 22%, and we'll look to be opportunistic on buybacks if it makes sense as well. Finally, just kind of going back to outlook, we're expecting to see double-digit revenue growth At this point in time, what we're looking to do is to provide full guidance, probably after Q1, based on essentially macro factors. We hope to have more visibility on interest rates, and also the cadence of projects, as well as the growth on the single family initiatives where we have less visibility, mainly how the vinyl deliveries are trending and how the legacy business is trending, again, based on those macroeconomic factors. With that, I'll leave you, and we'll see you after Q1. Thanks again, and thanks for following Tecnoglass.